Welcome to the debate. Imagine you are Microsoft or Google or Meta. You're sitting on $1 trillion market cap, effectively holding a blank check, right?
Right. A practically infinite budget.
Exactly. And you are locked in this existential arms race to build the future of artificial intelligence. You have the capital, you have the software engineers, the data, and yet, well, your entire strategic roadmap currently hinges on a 15% price hike driven by 3 memory manufacturers halfway across the world.
It is honestly a remarkable bottleneck. I mean, the entire tech industry is essentially being held hostage by a single line item on a bill of materials.
It really is. And for any economics students tuning in today, we are looking at a highly complex diagnostic landscape for tech infrastructure. It's a perfect real-time case study of sectoral inflation. Recently, notifications went out across the data center industry that Nvidia's AI servers are facing this 15% price hike.
Yeah, and this is for systems shipping early next year, right?
Right, which crucially includes their flagship Vera Rubin and Grace Blackwell systems. But the catalyst for this price spike isn't necessarily Nvidia's own silicon. The pressure is actually coming from upstream, driven by soaring costs for dynamic random access memory, or DRAM.
And that upstream origin is what makes this so critical to analyze. I mean, the major hyperscalers have all been put on notice. This isn't just some standard vendor negotiation. It is a profound shift in where the power lies in the hardware supply chain.
I see why some look at this dynamic and start projecting, doomsday scenarios for tech pricing. But let me give you a slightly different perspective. I view this as a classic, albeit very painful, temporary microeconomic supply bottleneck.
Temporary? Really?
Yes, temporary. If you look at the fundamental mechanics of market equilibrium, what we are witnessing is just a cyclical price spike in a very specific commodity market. Memory chips have always gone through these boom and bust cycles. As production inevitably scales to meet this massive new AI-driven demand, the market will resolve itself.
So you think it just self-corrects?
Exactly. The high prices will fund the new fabrication plants. This 15% increase is just friction in a rapidly expanding market. It is not a permanent driver of industry-wide structural inflation.
Well, I come at it from a completely different angle. I look at the very same data, the exact same supply chain, and I see a massive structural inflationary shift. This isn't just temporary friction. This is a textbook demonstration of extreme inelastic demand colliding head-on with oligopolistic leverage.
Oligopolistic leverage is a strong term.
But it's accurate. The fact that memory suppliers can force these massive costs onto the industry's most dominant player, Nvidia, who then passes them perfectly downstream without absorbing a single dime, that shows this won't be a temporary blip. These costs are going to cascade through the entire data center ecosystem, ultimately elevating the baseline cost of compute and creating persistent inflation across the broader tech economy for years.
Okay, let's lay out the mechanics of this. Because differentiating between a cyclical bottleneck and a permanent restructuring of tech costs is the core issue here. My position rests heavily on the historical behavior of the semiconductor capital investment cycle.
Which is notoriously volatile.
Right, exactly, yes. The big 3 DRAM manufacturers, Samsung, SK Hynix, and Micron, they haven't entirely caught up with this surging demand for AI infrastructure. But they are just sitting on their hands. They're actively retooling, they're increasing output. There is a foundational rule in commodity economics. The best cure for high prices is high prices.
That's a nice textbook theory, but you're treating this like we're trading copper or timber.
Well, the principle still applies. The massive premium currently placed on high bandwidth memory is the exact market signal required. It incentivizes these manufacturers to deploy billions in capital expenditure to clear the shortage. The 15% increase is simply the cost of doing business in a market expanding way faster than the physical supply chain can currently accommodate.
I hear you, but have you considered the unique, hyper-concentrated market structure we're actually dealing with here? This situation completely defies standard equilibrium models. We are talking about an extreme oligopoly. Just 3 companies control almost the entirety of the world's DRAM production.
Sure, it's concentrated, but
highly concentrated. And then you look at the intermediary passing on these costs. Nvidia. Here's a company operating with a staggering 75% gross margin. The fact that a dominant entity like Nvidia cannot, or maybe simply will not, absorb these memory costs proves that the upstream suppliers possess unprecedented leverage.
Wait, but is it leverage or just market reality?
It's leverage. Because there is a total dearth of viable alternatives to Nvidia's accelerators right now, the hyperscalers just have to swallow these hikes. This isn't a cycle resolving itself. This is a permanent reset of the cost foundation for the whole sector.
I think we need to isolate the root cause first before we track how this inflation transmits through the rest of the economy. Let's look really closely at those DRAM manufacturers. Samsung, SK Hynix, Micron. You characterize their position as unprecedented leverage, almost like a cartel.
It functions quite similarly to one right now.
But we have to explain why memory is suddenly the absolute choke point of the global economy. It's not because they're manipulating the market.
No, it's because of the architecture of AI computation itself.
Exactly. Nvidia's graphics processing units, the GPUs, are the engines of AI. But their effectiveness is entirely bottlenecked by how much memory they're paired with. There's this concept in computer science called the von Neumann bottleneck. Essentially, the processor can calculate information much, much faster than the memory can feed data into it.
Right, it creates a massive traffic jam.
Precisely. If we use a mechanical metaphor, the Nvidia GPU is this massively powerful V12 engine, but the DRAM is the fuel pump. It does not matter how fast that engine can theoretically run if the fuel pump can't deliver the gasoline fast enough. The engine just starves.
And to solve that starvation, the industry moved to high bandwidth memory, or HBM, which is this highly specialized stacked form of DRAM. And that physical dependency is exactly what grants those three Korean and American companies their oligopoly power.
But calling it oligopoly power implies intent to restrict.
They aren't just selling a standard commodity anymore. They hold the keys to the entire AI transition. And we know this leverage isn't isolated just to enterprise AI servers. When you look at the broader tech sector, major companies like Apple and Qualcomm have also recently signaled they're facing higher costs due to chip shortages.
Well, consumer electronics are definitely feeling the pinch too, yeah.
Exactly. When the exact same suppliers are forcing price hikes on consumer smartphones and million-dollar AI server racks simultaneously, you are looking at broad systemic inflation dictated by an oligopoly.
I see why you think that, but let me give you a different perspective on how that oligopoly is actually functioning. When I hear oligopoly dictating inflation, my mind immediately goes to, OPEC in the 1970s, a cartel intentionally holding back supply to artificially inflate prices. But is this truly unprecedented, malicious leverage, or is it just the peak of the silicon cycle?
Does the intent even matter?
Yes, because it changes the long-term outlook. Samsung, SK Hynix, and Micron aren't restricting supply. They are running their fabrication plants at absolute maximum capacity. They are frantically trying to build more, but they are supply constrained by the brutal laws of physics and the reality of advanced manufacturing.
You're referring to the complexity of packaging the HBM.
Yes, building an HBM fabrication plant isn't like building a warehouse. It takes 3 to 5 years. You need hyper-clean environments, you need specialized lithography machines from ASML, and most importantly, HBM requires microscopic, high-precision packaging to stack these memory chips on top of each other.
The through-silicon vias.
Right, connecting them with microscopic wires called through-silicon vias. The failure rates are incredibly high. They are constrained by the physical difficulty of the manufacturing process, not by a cartel agreement to starve the market. Eventually, they will master the yields, the fabs will come online, and the supply will flood the market.
I'm sorry, but I just don't buy that the intent matters as much as the mechanical outcome. Whether they are intentionally restricting supply in a smoke-filled room, or they're just physically incapable of meeting demand due to manufacturing complexities, the economic effect on the tech sector is exactly the same.
But one is temporary and one is structural.
They have pricing power that they are exercising ruthlessly. And because the barrier to entry for manufacturing high-bandwidth memory is astronomically high, requiring tens of billions of dollars and years of specialized engineering, that supply constraint isn't going to vanish in a few quarters. By the time that new capacity comes online in 3 or 4 years, the baseline cost of computing will have been elevated for a full product generation. That's what makes this structural sectoral inflation.
Okay, but that leads us directly to the transmission mechanism, which I actually find even more fascinating from a microeconomic perspective.
Yes, let's talk about Nvidia.
Nvidia is one of the most profitable companies in the history of semiconductors. As we noted, they operate with a 75% gross margin. This is a margin originally derived from selling high-end PC gaming chips, which they have successfully transplanted into the enterprise AI accelerator market.
A rather spectacular pivot, honestly.
Truly spectacular. But here's where I am just not convinced by your transmission narrative. With margins that thick, traditional economic theory suggests a company has a massive buffer to absorb upstream cost shocks. Wait, I actually need to stop and push you on this, because it totally defies business logic.
How so?
75% margin? You are telling me a company making that much profit can't just absorb a 15% bump in memory costs to keep their biggest clients who buy in the billions happy? Why would they risk passing the buck and angering Microsoft or Meta?
Because they can't. That's the absolute definition of inelastic demand. Nvidia doesn't need to protect those relationships with discounts because the hyperscalers have nowhere else to go. Nvidia is charging tens of thousands of dollars per chip because supply from their contract manufacturers still cannot meet this runaway demand.
It's a seller's market, certainly.
Think of Nvidia as a toll booth operator on the only bridge into a booming gold rush city. The toll booth operator doesn't care if the concrete and steel required to maintain the bridge suddenly cost 15% more. They don't absorb that cost. They just raise the toll on the drivers. Why? Because the drivers have absolutely no other way to get into the city.
So you view it purely as a function of captive pricing power.
Exactly. When you have a line of trillion-dollar companies begging for your product to build out their data centers, you have zero incentive to eat a cost increase. Nvidia's margin inflexibility perfectly demonstrates how inflationary pressures are transmitted seamlessly downstream when a market is entirely captured. The toll goes up, and the drivers just have to pay it.
That's a really interesting point, though I would frame it quite differently. I don't think it's just about a captured market or blunt pricing power. I think it's about market signaling and the long-term mechanics of competition.
Signaling? To whom?
To the entire industry. If Nvidia absorbs the cost, they artificially suppress the price of the final server. By passing the cost along, they are allowing the true, painful market price of the scarce resource, the memory, to be felt by the end consumer, the hyperscalers. But more importantly, I question the longevity of this dynamic. You say there are no other bridges into the city.
Right now, there aren't.
Today, that might be true. But major customers like Amazon, Microsoft, Google, and Meta aren't just sitting around helplessly paying the toll. They are all actively pursuing their own in-house silicon programs.
They are, yeah, but they are still completely dependent on Nvidia for their current generation of data center build-outs.
For now. But sustained, aggressively high prices create an umbrella under which competitors can innovate and survive. Nvidia's aggressive pricing, refusing to eat that 15% hike, is going to dramatically accelerate the return on investment for those in-house silicon programs.
You think it pushes them away faster?
Absolutely. Take Google's tensor processing units, their TPUs, or Amazon's Trainium chips. If Nvidia servers get 15% more expensive, the internal business case for a hyperscaler to fund and deploy their own proprietary chips becomes massively more attractive. By passing on the costs, Nvidia is literally funding the financial justification for its own competitors. I argue this creates a natural, inevitable ceiling to this cost inflation. The ultimate cure for Nvidia's pricing power is the massive financial incentive it creates for substitutes to enter the market.
That's a compelling argument, but have you considered the foundational flaw in that escape plan?
What flaw?
Let's say the hyperscalers achieve exactly what you're describing. Let's say Google completely replaces Nvidia chips with their own proprietary TPUs for all internal workloads. Guess what those TPUs still desperately need to function?
Well, the memory, the DRAM.
Exactly. They still need massive continuous amounts of high bandwidth memory to feed the data to the processor. So even if the hyperscalers manage to bypass Nvidia, build their own bridge, and push forward with greater independence, their ability to do so will still depend on their access to supply from Samsung, SK Hynix, and Micron.
The oligopoly at the foundation.
Remains completely untouched. You haven't solved the structural inflation at all. You've merely removed the middleman. The fuel pump is still controlled by the same three companies, and the cost basis of the entire tech sector remains fundamentally elevated.
Okay, I concede that the memory dependency remains and the von Neumann bottleneck isn't going anywhere anytime soon. But removing the 75% margin intermediary absolutely changes the compounding cost structure of the final server. However, to truly analyze how these prices affect the broader economy, we really need to track this transmission mechanism all the way to its final destination.
You mean the physical deployment?
Yes, the physical deployment of these servers by the hyperscalers. I argue that this AI infrastructure build-out is already slamming into severe physical and macroeconomic headwinds that will act as a natural, unavoidable brake on demand.
So you're shifting from the silicon constraints to the physical infrastructure constraints.
Yes, because at some point, the software has to live in the physical world. The reports are everywhere across the industry right now. We are seeing major multi-year project delays. There are acute labor shortages. And I don't just mean general construction.
Right, specialized labor.
I'm talking about highly specialized electricians who can wire gigawatt facilities, and specialized HVAC engineers who can design the liquid cooling systems required by these incredibly hot Vera Rubin chips.
The thermal constraints are very, very real.
Exactly. And beyond labor, we are looking at a fundamentally altered capital market. Higher interest rates make financing a $5 billion data center vastly more expensive than it was during the zero interest rate era. And perhaps most critically, there is growing organized community resistance.
The power grid issues.
Right. Local municipalities from Virginia to Ireland are pushing back against data centers because they threaten to drain local water tables for cooling. And they are completely overwhelming regional power grids. You literally cannot plug these servers in without functionally requiring a dedicated nuclear reactor in some of these zones.
All very real, well-documented phenomenons.
Right. So my point is that these compounding physical complexities will naturally cool this runaway demand. A hyperscaler cannot buy an unlimited number of 15% more expensive Nvidia servers if they literally do not have the physical buildings, the trained electricians, or the municipal power permits to plug them in.
You think it forces a pause?
Yes. This physical friction will force a cooling off period in the purchasing cycle. It will force a price equilibrium before structural inflation takes root across the wider economy, because demand must eventually respect the physical limits of the real world. At some point, the budget just breaks.
I mean, I'm not convinced by that line of reasoning at all, because you are misidentifying the fundamental economic nature of those constraints. You are looking at project delays, labor shortages, and power grid limits, and you're categorizing them as brakes on demand. They are not.
What are they then?
They are supply-side constraints on the physical infrastructure itself. And in this specific environment, they actually exacerbate the inflation rather than cool it.
How so? If they physically can't build the data center, they don't buy the chips. The demand drops.
You are assuming the demand has standard price elasticity. It doesn't. The demand from the hyperscalers is deeply, profoundly inelastic. We are in the middle of a generational, existential arms race. Microsoft cannot afford to lose the AI platform war to Google, and Meta cannot afford to lose the algorithmic edge to Amazon.
They certainly spend like it's existential.
Because they view this as a tectonic technological shift. If you are a trillion-dollar company, losing the AI war means losing hundreds of billions in future market cap. Therefore, their demand for infrastructure doesn't just disappear because a permit got delayed or because specialized electricians are scarce. They don't walk away. They simply pay more to overcome those hurdles.
But there has to be a ceiling somewhere.
Not in an existential threat scenario. They will pay massive premiums to expedite construction. They will pay double wages to poach scarce labor. They will co-invest in local power grid upgrades. And yes, they will absolutely pay the 15% premium on the Nvidia servers.
So you were saying the physical friction just becomes another premium added to the final bill.
Precisely. And the crucial part of this transmission mechanism is where those compounding costs ultimately end up. The hyperscalers will absorb the inflated server costs, the inflated construction costs, the inflated capital costs, and the premium for power. and then they will bake all of that directly into the price they charge developers and enterprises to use their AI models.
Passing it to the software layer.
Exactly. The structural inflation gets passed directly to the software layer. Every hospital integrating AI diagnostics, every logistics company using AI for routing, every enterprise software platform, they are all going to pay for that DRAM shortage and that specialized electrician. That is how a microeconomic hardware bottleneck metastasizes into macroeconomic, persistent, industry-wide sectoral inflation.
Well, I think we've clearly mapped the mechanics of the two divergent paths this could take. The 15% price hike on these high-end AI systems truly provides a fascinating window into how supply chain choke points interact with inelastic demand in a highly concentrated, high-stakes market.
It is a remarkable transmission mechanism, tracing the cost increase from raw material, the specialized packaging of the memory, through a dominant intermediary holding a 75% margin, and all the way down to the physical infrastructure layer. It really lays bare the mechanics of the modern tech economy.
It really does. And I think we have a strong area of convergence here. We both agree that currently the memory manufacturers, the DRAM and HBM producers, hold the undeniable linchpin of power in the AI ecosystem. The absolute inability of current silicon manufacturing to meet this runaway demand is creating profound, undeniable friction across the entire tech industry.
No doubt about it.
The von Neumann bottleneck isn't just a computer science problem anymore. It's a macroeconomic reality.
Absolutely. The leverage has, either temporarily or permanently, shifted away from the software giants and upstream to the hardware fabricators.
Where we fundamentally diverge is on the time horizon and the elasticity of the market. I maintain this is a painful but cyclical microeconomic adjustment. The capital markets will work. High prices will do their job. They will fund massive expansions in memory fabrication capacity, and Nvidia's refusal to absorb costs will rapidly accelerate the deployment of in-house custom silicon among the hyperscalers.
Finally introducing real competition, you think?
Exactly. Finally introducing real competition to the compute layer. The physical world will force a pause, and the market will self-correct.
And I hold that the oligopolistic nature of both the memory market and the accelerator market prevents a standard self-correction. Because the hyperscalers are engaged in an existential arms race, their demand is entirely inelastic. These price hikes aren't just temporary friction, they represent a structural, persistent inflation of the tech sector's underlying, unavoidable infrastructure.
Well, we won't have to wait long for the next major data point to test these theories. Nvidia is actually set to report its fiscal second quarter earnings on August 26th.
That is going to be the true test of this entire ecosystem. I mean, the financial updates from the world's most valuable publicly traded company have essentially become the ultimate bellwether for the global economy.
The whole market watches them.
Right. How those hyperscalers respond in that earnings report, whether we see them finally blink at the rising capital expenditures, or whether they just double down and absorb the costs to keep buying, will tell us exactly how inelastic this demand truly is.
It leaves us to reflect on just how fragile this entire technological revolution might be. We are looking at a multi-trillion-dollar transformation of the global economy, driven by the brightest minds in software, and yet it is entirely dependent on the microscopic packaging of memory chips halfway across the world. It seems the perfect intersection of supply and demand might be a bit harder to achieve than the textbook model suggests. We'll be watching those earnings closely.